predatory tokenomics, or what could be construed as predatory tokenomics. In other words, it might benefit the people issuing the token a lot more than it benefits the people that are buying it, even if you get in kind of early. Predatory tokenomics model is being referred to as a low float, high FDV model. This allows insiders to sell tokens before their vesting schedules actually end. We'll talk about that. The expectation that there are vesting schedules for insiders, VCs, founding team members. Well, that's just not the case. So let's take a look. All right, so this is Binance research. Low float and high FDV. How did we get here? And there's a full report you could download here. They're saying a lot of people in the crypto community are discussing these high valuation tokens with an initial low circulating supply. That's the low float. That's the tokens available to be traded. They cite data from CoinMarketCap and Token Unlocks. And it's an analytics site. And it can confirm there is a growing trend of tokens. And I pay attention mostly to Cosmos. I've noticed this as well, whether it's Celestia, Dimension, Saga, Archway, we'll look at as well. It's basically saying that there are some really aggressive valuations and some positive market sentiment. And this has accelerated this trend, this high FDV, which is fully diluted valuation. This is the valuation of the token, the market cap, if all the tokens were in circulation. And they're usually not. Let's look at Celestia as my example here. They basically created and rode the narrative of modularity for probably like all of 2023. And they launched a token in fall of 2023. This is cryptorank.io, and I can get some information about the token here. Got off to a great start, right? They airdropped a bunch of their tokens. Sometimes with airdrops, there's an initial dump, and there was for like a couple days. And then it basically did a 10x, 8 to 10x, and has sold off 50%. All the while Bitcoin's hitting all-time highs, right? So it's tough because it's not tracking as many alts are finding. It's not easy to track the crypto markets at all. But what's interesting about Celestia is that, yeah, it went to $20, but some of the early investors, the early backers, they got in really cheap. They got in, some of them at a penny, right? So they're up almost 1,000% even after this 50% dip. But the problem is their tokens are supposed to be locked in vesting contracts, so they don't have access to the tokens right away. This would qualify as one of those low float, high FDV tokens because the valuation was in the billions or in the hundreds of millions at least. Here you could look at vesting. And blue is unlocked. The 16.8%, this green is what's next to unlock. And then the rest of it is locked for beyond that time. And these locked tokens are people who invested early and helped get the protocol off the ground, funded development early on. These were not public. This is the 1-year cliff. So the token must have launched October 31st of 2023. And those tokens that were bought at these really cheap prices are supposed to be locked for a year. And if you're buying TIA token, you might say, this is great. I get to buy and sell my token when the insiders can't. Well, it's not entirely true because they're able to use their tokens to take advantage of inflationary rewards like staking, possibly LPing. And I'm not picking on Celestia here. I'm using Celestia as an example. In general, the problem here is even with these vesting schedules, which are tough, right? You invest all this money, you wait, then the token launches. You got to wait a year, 2 years, 3 years to be able to recoup your initial investment. Well, with these new deals, the investors are able to farm. They're able to farm. And they can make back way more than their initial investment before the vesting unlocks happen. And it's not fair. It defeats the purpose of the vesting schedule. Let's go back to fundraising. And I'm not picking on Celestia. They're just a great example because if I'm able to get in at a penny, I don't even care about the price action if I'm able to stake this token and earn the 10, 12, 15% APY, which if the the price of the token was still a penny, it would be not such a great investment. I'd have to really be hoping by the end of my unlocks, the token has gone up. And I took substantial risk, so I'm expecting substantial upside. But if the token is $10 and I'm up 100x, I don't have to stake the token that long to recoup my initial investment, right? Well, if the price goes up 100x, I don't even care about my initial amount. I want to farm while I can while the prices are high. As a VC, early investor, even founding team member, by the time all my tokens unlock, I don't have to even sell it. And I made a fortune. Meanwhile, everyone else that didn't participate in these early seed rounds, they're buying at a high valuation, a really high valuation. So if you're researching tokens and you're like, oh, I'm worried about tokenomics that could be considered somewhat predatory, well, look no further than Dimension. It's a new token that launched. It went up initially, like Celestia did, but in very short order, it's gone down. And that's because those that got in early with Dimension, from what I understand, were not only able to farm, they're able to sell. So whatever the valuation is, let's assume it was way lower than the price when it hit the open market, $4.70. If I got in at 40 cents, I'm up 10x. I might be selling a bunch of it here. So as an early investor, how much value am I actually bringing to this token if the design is like this? As an early investor, VC, founding team member, seed round investor, whoever you want to point a finger at, I took on a lot of risk waiting for this to launch. I got to make some money back, but this almost kills the token out of the gate. The market cap of the token is the current price multiplied by the circulating supply. And I know there might be different definitions for circulating supply. I would consider circulating supply to be any tokens that are not locked in some kind of vesting contract. Okay. Basically, what's tradable on the market right now. The fully diluted valuation is always higher than the market cap because this takes into account all the tokens, the total supply. And what's the total supply? The total supply is any supply that has ever been set programmatically to be minted minus whatever was burned, right? So it's like the max supply is the coded supply, the coded max supply, like with Bitcoin, it's like 21 million whatever tokens. That's the max supply. But if someone burns a whole bunch of Bitcoin, let's say a million gets burned, the total supply can only ever be 20 million. So total supply is usually going to be a little less than max supply. But anyway, the market cap's based on the circulating supply. Those are the available tokens to be traded. And then FDV, this is the total valuation as if all the tokens were in circulation. You could see this is almost 10 times higher, right? It's 8 times higher. These teams aggressively value the project while also only releasing a small amount of tokens at the onset of the launch. This creates kind of a perfect storm for price action, which is what everybody wants, but it's very temporary. What I mean by price action, there's a supply squeeze right out of the gate at the exact moment that hype is at its peak. The launch of a token is the peak of interest, anticipation, and of course, marketing. You get this supply squeeze. People are buying because they either could not participate in these early investment rounds, did not get an airdrop, right? So they're late. And they're actually really late, even if they're buying the first day the token's available on a DEX. Here's SWI, same thing. Price action actually dipped out of the gate, right? It launched around this time last year. So obviously the summer was brutal for altcoins. So it sold off, spiked, and now we're having this other massive dip. So let's look at the float here. Well, market cap is 2.5 billion. That's the value of the tokens in the circulating supply, but the FDV is almost 11 billion. That means only about 25% of the supply is in circulation right now. Archway. Here's an interesting one because Archway, I don't think the numbers are reported properly. This has the circulating supply at 300 million, giving it a market cap of 31 million. It's about 10 cents per token. Nice, easy numbers here. FDV is 107 million. So basically, about 30 to 35% of the tokens for Archway are in circulation, but that's not really true because some of these are vesting still. And the numbers that I was able to pull off another analytics website, Token Track, shows this. This is like a linear expression of where the tokens were initially allocated at Genesis and when they will be available to be sold. This doesn't mean they're going to be sold, they're available to be sold. Archway is of interest of me because I hold a whole bunch of AXV tokens, which is a DeFi token on the Archway chain. So I don't want Archway to perform badly, obviously. But in the beginning, the Genesis event was July 21st. Token went live. Very low float. About 50 million tokens were available out of the 500 million max supply, total supply. That's only 10%. But because of inflation, staking rewards, bootstrapping liquidity, right? At the end of the first 12 months of its life cycle, the Archway layer 1 token, Arch token, the supply will double. What happens here? The supply balloons after this. So from this July to January, we go from 100 million circulating supply to 200 million. So it's going to double again. That's 4x in a year and a half. And then in the next year, it doubles again. With all these unlocks, people who bought early and had to wait, and I don't know if Archway early backers, founding team members, and early investors are able to able to farm with their tokens. That I don't know. But this is of interest if you hold the token because you're holding the token when there's basically a supply squeeze here. And then over the next year to 2 years, there is no longer a supply squeeze. And you might be thinking, so what? Well, that directly affects the price because inflation dilutes the value of the tokens that are already in circulation. And I'll give you a great example. This is the graph. So why am I showing you the graph? This is not a new token. No, it's not. This is about 3.5 years old, this token. And we could ignore all this price action because the market conditions were different. And then there's this long lull. And then we get a little life here. I actually bought somewhere over here. So I'm interested in this token. I'm looking at the price. Peak price was February 12th, 2021. What happened after that? Well, that was a low float token. Look how low the market cap was. Even with a high price, the overall market cap was low because the circulating supply was low. Peak market cap was here, November 6th, 2021. Well, the price must have been really high here if the market cap was high. Market cap is the total value of the tokens in circulation. But let's look at the price. No, the price had already sold off more than, roughly 50% from the highs. But how's that possible if the market cap is high? How's that possible? It's possible because of the way the inflation schedules work. Emitting more tokens into the ecosystem dilutes what's already there. People need to be aware of where the selling of the token can come from. And a lot of times it's just coming from the inflation, staking rewards, LP rewards, airdrops, unlocks, which is what we just looked at with Celestia and Archway. There are unlocks happening. Causes the supply to balloon. What happens to the tokens that you're holding? They get diluted. How do I not get diluted? Well, either you have to be a beneficiary of that inflation or the new unlocks to accumulate more tokens, or you have to buy them, or you have to sell before before this happens. Boom. Look at this. From about $2.50 down to 50 cents. That's an epic implosion here. It's an epic implosion. And this is not even it's not even a bear market. The market, the inflation schedule, whatever it was, vesting schedule for the graph. I'm not familiar with what it was. I bought all the way over here. I bought about 6 months ago. I had no idea what the graph was until 6 months ago. But inflation is probably what killed this token price. Maybe some news, maybe there was a protocol hack, whatever. But really, it's the inflation because the value kept going up as the price is going down. And that's all I wanted to show you to make the point that these low float, high FDV tokens, they might be predatory. They might be the best way to get tokens into the ecosystem for some. It's definitely not the best way for tokens to get into the ecosystem if you're buying it over here, not even at the peak valuation. So Binance, I'm going to keep following, see if Binance keeps it up. I see a lot of these on Binance Smart Chain. So it's interesting that Binance put out this report because I think that that's the place where I first became aware of these. I'm looking at these DeFi tokens on Binance, and what do I see? Only 14% of the supply is in circulation. I'm not going to buy that. I'm worried about where the rest of the supply is going to come from, when it's going to come, and how much at one time.